Hello, welcome to Accounting with Mr. H. In this video, we are looking at partnership accounts, and in particular, we are going to look at how to deal with a partner who is retiring from the partnership. And that's going to involve preparing a revaluation account and looking at the capital accounts. Please do remember to subscribe to the channel. Thank you if you already have done. Like, share, and comment on the videos, letting me know what you find useful and what you'd like to see in future videos. Right then, here's the question for this video. As I say, we're focusing on the retirement of a partner. It's often called retirement in questions, but effectively it's any partner who is leaving. It could be the partners, there's been a falling out between them and one of the partners wants to leave. Maybe one of them just wants to have a different career. As I say, it could be retirement. But any time, if a partner wants to leave a partnership, then this video is looking at the steps we have to take. So on the left-hand side then, what have we got? We've got Jim, Kim and Prim are in partnership, sharing profits and losses 4-1 respectively. The following information has been taken from the partnership's books at the 31st of December, and I can see they've given me the property and the fixtures and fittings at net book value. And I've also been told the value of the trade receivables. And then they've given me the balances of each of the partners' capital accounts. Additional information, Prim is retiring on the 31st of December. And the partners have agreed that, and then these next 4 bullet points are what we call valuations. And that's something I'm going to pick up in a minute as we move on to the next slide. It then tells us Jim and Kim will continue in partnership, sharing profits and losses equally. And any monies owing to Prim will be paid from the partnership's bank account. So once Prim's retired, she takes her money with her that she's owed, and then Jim and Kim carry on the business, just the two of them working in partnership as equal financial partners. And we're being asked to prepare the capital accounts for the partnership at the 31st of December. So these will then show the effect of Prim's retirement. So like many T accounts, you'll see I've drawn them out ready. So I've got my capital accounts drawn. And like many T accounts, the first thing to do is to put in any opening balances. Hopefully you will know that capital has an opening balance on the credit side. So this is going to be simple. They've told me what they are. So here we go. Balance is brought down. Let's get these written in. Jim 55, Kim 46, and Prim 39,000. Done. Then the second thing I need to do when I'm dealing with a partner who's leaving or retiring is to do something called a revaluation. And what this is about is if you look at, for instance, the property, in their books, it says the net book value of the property is 230,000. But they've now agreed on Prim's retirement, they've reassessed it, if you like, and they've agreed that actually the property should be valued at 260,000. So what we're going to look at, and I'm going to explain in more detail, is why that might have happened and then how we deal with it. And this is known as a revaluation. So I'm going to need quite a bit of working for this bit and another T account. So let me get this set up. Okay, here we go then with our workings. So as I say, we're going to prepare something called a revaluation account. So there it is as our T account done. And the idea is we are looking at how the values of anything have changed between what it says in the books and what the partners have agreed when the partner is leaving, or in this case, retiring. So let's explain as we go along. So let's look at the property to begin with. So it says in the books, the property has a net book value of £230,000. In the additional information, it says the partners have agreed that the property is now to be valued at £260,000. So they've had a look, they've reflected on it, and they've decided the figure currently in their books is a little bit low. Maybe current market conditions in property, actually the property they've decided and agreed is worth £30,000 more. Now it's only fair that Prim gets a share of that extra £30,000 as she leaves. Because she's been there, she's been taking the risks and invested the capital, she's been a part of this partnership while they've had that property. So we need to effectively give her her share of the 30,000. So the way this is going to work then, so I'm going to get some workings going. Here we go. So working number one. So the property then we've said is gone up in value by £30,000. If you visualize the property account itself, property is an asset. So it would have a debit balance currently of 230,000. And we now need to increase that to 260,000. So you would need to put 30,000 on the debit of the property account. So you're going to debit the property account, which means we're going to credit this revaluation account, and there it is. Second thing that's happened, the fixtures and fittings in the books have a net book value of 72,000, but the partners have now agreed that they should be valued at 66,000. So the difference, another working number two, the difference is 6,000, but this time it's a decrease in value. Maybe they've decided they haven't quite done enough depreciation. Maybe they've realised one of the fixtures and fittings is in a bit of more sorry state than they thought. So they've said, actually, these fixtures, they're not worth 72, they're only worth 66. Well, it's only fair that Prim gets some of that 30,000 from the property. It's equally only fair that Prim suffers some of this 6,000 fall in value on the fixtures. So again, imagine the T account, the fixtures and fittings account. That's an asset again. So it's currently got a balance on the debit of 72,000. We need to reduce that to 66. So we'll need to credit fixtures and fittings with 6,000, which means we will then debit the revaluation with 6,000. And there we go. And then the final one we've been given in this question is the trade receivables. They've got a value in the books of 9,240, but they've agreed they should actually be valued at 7,710. So there it is. So the difference is 1,530. Again, visualize the T account. So trade receivables are an asset. So the balance is currently on the debit, 9,240. In order to reduce that, we've got to put 1,530 on the credit of trade receivables, which means we've got to debit the revaluation. Maybe they've realised one or two of those receivables are very unlikely to pay. So again, before Prim leaves, or as she leaves, it's only right that she suffers some of that loss. Hopefully that's made sense with the double entry. If you just think of it without double entry, we're basically saying if it's a gain, then we're putting it on the credit of revaluation. But if something has fallen in value, if it's almost like a loss to the partners, we're putting it on the debit. Then what I'm going to do is work out the overall net gain. So see which side of the revaluation account has got the most on it. In this case, it's the credit side, so I can total that at 30,000. Doesn't always have to be the credit side, so just go with whichever side's got the most on it. And then I'm going to work out how much we've got to share out. So let me get another little box. There we go. So there's 30,000 on the credit. I'm going to take away what's on the debit, so the 6,000 and the 1,530. Leaves me with 22,470 to be shared out between the partners. I have to share this out between all three of them. I can't just do it for Prim, even though it's just her leaving. We have to now adjust the capital figures for all three partners. And unless it tells me otherwise, I'm going to share out this 22,470 in their last agreed profit ratio, which in the question, Jim, Kim and Prim, their ratio in their partnership, the three of them, is 4:1. So Jim then is having 4/7 of that 22,470. And so I'm going to put that on the debit of revaluation, and you'll see I'm sending it to his capital account. Do the same for Kim. She's having 2/7 of the 22,470. So 22,470 divided by 7 multiplied by 2. She's getting then 6,420. Send that to her capital account. And then finally, Prim is just getting 1/7. So she's going to have 3,210. And then let me send that to her capital account. And then just as a final double check, like any T account, I can total up the debit side, and that gets me to the 30,000. So I know arithmetically everything I've done is correct. Right, let's get back to the capital accounts then. You'll see I've just put in a yellow box there, the revaluation account we've just done, so that I can refer to it. So the first thing I'm going to do is double enter the revaluation figures from the revaluation account into the capital accounts. So in the revaluation account, we have debited Jim with 12,840. So I'm now going to credit that into Jim's capital account. Here it comes. There we go. And then Kim 6,420 and Prim 3,210. So I've basically increased each of their capital balances by a share of the revaluation, the net revaluation figure. And then that's literally the double entry: debit the revaluation account and then credit the capital account. But remember, as I said a moment ago, it is possible that in a revaluation account, you could have ended up with the capital account figures on the credit side, in which case they would obviously then be on the debit side in the capital accounts. Next thing to look at then, if I look at the additional information, the very last bullet point says the partners have agreed intangible assets, goodwill, will be valued at £56,000 and then be written off. Now, goodwill is a type of what we call intangible asset. Intangible means it's not something like a physical thing. So whereas the property and the fixtures and fittings are what we call tangible assets, they're physical. You can see them, fixtures, you can touch them, you might be able to hold some of them. But intangible assets are things that don't have a physical substance to them. And so the main example we see in these sorts of questions is goodwill. And what we mean by goodwill is, over the years that Jim, Kim and Prim have been in partnership, they've built up a certain reputation for their business, for their partnership business. And that has to be worth something. You know, it's probably got some brand recognition. It's something that perhaps they have repeat purchase, customers go back to them, whatever they do. Well, that's got to be worth something. And Prim's been a part of that in building up the partnership and that reputation. So as she is retiring, it's only fair that she gets a share of that in addition to the share of the physical assets that we've just worked out in the revaluation. So what the partners will do, if they decide to do it, as they have done here, they will agree on a figure for intangible assets, in this case £56,000. And so we need to share that out between the partners. Again, although it's only Prim that's leaving, we have to do it for all of them in order to keep it fair and balanced between the three partners. So I'm going to look then, let me put an entry in, there we go. So intangible assets, these are going to go on the credit side. And my working then is going to take this £56,000 that they've agreed on. And again, unless it tells me otherwise, just like the revaluation, I'm going to share it out in their profit ratio, which is the 4:1. So of this 56,000, Jim is having 4/7 of it. So let's put that in his capital account. There we go. Kim is having 2/7 of it. So 16,000 going into her capital account. And Prim is having 1/7. So 8,000 going into her capital account. There we go, done. Next thing then, if you look back at that bullet point, it says the intangible assets are to be valued at 56,000 and then be written off. And you'll normally see this in these sorts of questions. And what this is about is these figures are, the goodwill figures are very, very subjective. Because no, they didn't actually buy this goodwill. It's just something they've developed over the years that they've been in business. As I say, like their brand reputation, things like that. So when we talk about tangible assets like property, that has an objective figure. We can use the cost concept. We know that the property, we know how much we paid for it. We know how much we paid for the fixtures and fittings. But when it comes to goodwill, we never bought it. So the figure is very, very subjective. In other words, it's very, very opinionated. And so we don't leave that in the books because it would go against things like the cost concept, because we don't have an actual cost figure that we can base this decision on. So we've had to create the goodwill in order to give Prim a share of it, but we then immediately, what's called write it off, we remove it from the books of account. So what I'm now going to do on the debit side, let me put a narrative, there we go, I'm going to put intangible assets again. And I'm now going to what's called destroy this goodwill, remove it from the books, get it out. The figure isn't going to change because we've just put 56,000 in, shared out between the three of them. So now I need to take 56,000 out. But what is going to change is that now this is going to be the new partnership. So I create it in the old partnership between Jim, Kim and Prim, but I destroy it in the new partnership. And if you look near the end of the question, it said Jim and Kim will continue in partnership, sharing profits and losses equally. So that 56,000, I'm just going to share it 50-50. So Jim, so 56,000 divided by 2, 28,000, and we're going to put that on the debit of Jim's capital account. And then Kim, same thing, half then to her, and then put that in her capital on the debit side. You'll note I haven't put anything on Prim because Prim's leaving. The whole reason we've just done all this with the intangible assets is to make sure Prim gets a share of the goodwill as she retires. And basically, that 8,000 we put on the credit is what Prim's taking with her. They've agreed that her contribution to the partnership and building up the brand and the reputation and the customer loyalty to her, her share is £8,000 worth. So the whole point of all of that we've just done with these intangible assets is to give Prim that £8,000. So another little way to remember it is we create the goodwill and then we destroy the goodwill. When we create it, we credit the capital account. So credit, create. But then when we destroy it, we debit the capital account. So debit, destroy. So you credit to create the goodwill and then you debit to destroy the goodwill. But the other thing to remember is when we've done the things like the revaluation and the intangible assets, they've been done between Jim, Kim and Prim in their existing profit sharing ratio. But then when we've destroyed the intangible assets, this has been done just by the remaining partners, in this case Jim and Kim, in their new ratio, and they've decided they're going to now be equal partners in terms of profit and loss. Right, so all that remains for me to do then is to total off and balance off these accounts. And there's different ways of doing this. I often think the best thing to do is to start by looking at the partner that's retiring and let them retire. So Prim then, have a look at Prim's capital account. She's got nothing on the debit side and she's got 3 things on the credit side. So we know then that she's going to, it says withdraw the money that's owing to her from the bank account. So I'm going to put debit bank as my narrative. I'm going to total up what Prim has got on the credit side, and it comes to £50,210. So there's nothing to take away on the debit side. So she's going to take then £50,210 from the partnership bank account. So that's going to reduce her capital completely. It's going to eliminate it. That's right, because she's leaving, she's taking it all out. And that would be double entered to the credit of the cash book in the bank column because she's literally taking it from the partnership bank. And then I can total Prim's debit column. There we go. So Prim, she's gone. She's retired. She doesn't have a balance brought down. She can't have a balance brought down because she's left. She's gone. She's no longer a partner. And then just work through the other partners. So Jim, see which side's got the most on it. Again, it's the credit side. So total up Jim's credit side. There we go. It comes to 99,840. But he does have 28,000 on the debit. So take that away. And that's going to give me his new closing capital balance, which is 71,840. And then I can total that off and then bring that down so he's ready to go moving forward. And then finally do the same for Kim. So Kim's got more on the credit side, 46 plus 6,420 plus 16,000. Total up, take away the 28 on the debit of Kim's capital account, leaves her with a new balance of £40,420. Do the total to double check, bring down Kim's balance, and again, she's ready to go moving forward. We can see overall, if I was to look at Jim, he had an opening balance of 55,000 and he's finished with a closing balance of 71,840. Whereas Kim had an opening balance of 46,000 and has finished with a closing balance of 40,420. So, well, that's partly, so Jim, if you like, he's now got more capital, whereas Kim's got slightly less. Well, that's partly because of the adjustments through the revaluation, and it's partly because in Prim retiring, they've changed their profit sharing ratios. So when we've destroyed the goodwill, the intangible assets, that's also contributed to that effect. But there we go. That's the capital accounts complete. So there ends another video of Accounting with Mr. H. Again, hope you found it very useful. Please do subscribe to the channel, like, share, and comment below on what you'd like to see in future videos.